Hey everybody, welcome to this free edition of our Trader Use Group Weekly Roundup for the trading week ending November 5th, 2021. I'm Preston Brent. Thanks for tuning in. What a week we've had. I mean, it's just been very strong. Why don't we kind of take a step back and let's take a look at the weekly sound bites. First off, the index performance. As you can see, everybody's solid in the green for the week. Look at the Russell. 6.08% for the week, catching up with everybody else year to date, all double digits. Very, very strong week. You can see the forward PE ratio for the S&P is starting to become a little bit bubblicious here. Okay, it's up at 23.77. You can see the dividend yield for the S&P is falling just a little bit, which is what we'd expect. With the rising S&P, the yield is down to 1.27%. The 10-year Treasury also fell about 10 basis points this week. It came in at 1.45 for the week, still higher than the dividend yield, which kind of funnels money into the S&P. You can see the earnings yield for the S&P is coming in at 4.35%. A little bit higher than the 10-year Treasury at 2.84. So another reason money is coming into the markets. And there's a whole host of other reasons, which I'll talk about really briefly. The VIX also, believe it or not, actually closed up for the week 1.3% for the week. Last week it closed at 16.26. This week it closed at 16.48. Now, as I tell all our members, anytime the VIX moves up while you have the S&P also moving up, typically the VIX always wins. I would say 75 to 80% of the time, we generally are met by a little bit of a pullback in the markets and the VIX continues a little bit higher. I'm seeing that right now, so we need to be careful for the coming week. However, if we look at the best and worst sector performers for the week, discretionary came in strong at over 5%, healthcare bringing up the rear. Sector performance-wise, energy still on top for most of the year at 58.85%. Utilities coming in, bringing up the rear about 9.67%, still fairly strong. Now, if we look at the economic data for the week, we're getting strong economic data. I mean, this is what's happening. We're getting impressive weekly gains out of a couple of things. One, healthy economic data, which I'll talk about, a very dovish Fed, all right, strong end to the Q3 earnings season. We're seeing the Delta variant coming in a little bit. On top of it, Pfizer just came out and announced their one pill prescription for people that are starting to get early COVID symptoms, keeping them out of the hospital. So a lot of things are assisting this market. And if we look at it, we've only seen, we had 5%, just a little bit more than a 5% dip this year, this past September. And that was the first 5% dip we had in 227 trading days, also a record, all right? So mild to say the least. But since that dip, we've rallied about 9.9, almost 10%. And the path of least resistance so far seems to be to the upside. And looking at the economic data, you know, again, the Feds, they're going to start their tapering of 15 billion a month this month. And then it's really interesting. They didn't say they're going to do 15 billion a month in quantitative tightening or tapering. They said they're going to do it this month and in December. That leaves them open to increase the taper in January timeframe if the markets continue to get as strong as they are. Now, keep in mind the Feds are concentrating on employment. We did get the jobs data this Friday, and it showed 531,000 jobs adding, and the consensus estimate was lower than that. Employment rate fell to 4.6%. Okay. All of this is very strong. Now, this is going to bring on, I think, higher, more sticky, and less transitory inflation. We did see that the Labor Department also increased their prior August jobs by 235,000. Huge. September they increased that too. So really a lot. Now we're seeing also wages increase from Q2 to Q3 by 1.3%. That's the highest wage increase quarter by quarter since 2001. All right. So we're getting credit spreads out in the the bond market between treasuries and corporates tightening a little bit towards the end of the week. So that's showing that the markets are just not that worried right now. And then on top of all of this, we're getting the seasonality of the markets. November through December are the strongest times for the market to really be bullish. So you put all of this together, and since the September lows, we're up almost 10%. Really strong push. Okay, now I've been telling our members in our monthly or weekly market watch Sunday evening, we've been getting along some key things and just telling folks this is where you need to play. And for our members this Sunday night, we'll continue to recap some of that and talk about a couple of other plays as well as we go through the end of the year. Okay. Now, if we come over here and we look at, as I said, treasuries tightened a little bit. The 10-year yield fell 10 basis points. And we're just going to see stronger growth going through the end of this year. Profit margins are still strong with the Q3 earnings. So play it while it lasts, folks. It's not going to last, but play it while it lasts. Meanwhile, we've had strong Q3 earnings, so have they over in Europe as well. Okay. They're hoping bump the European markets strong. And like the Feds, the ECB, Christine Queen Bee Lagarde came out and said they're going to keep the rates low. They didn't hike the rates, and they're going to maintain that stimulus. So far, based on what she's saying, for quite some time. That helps the markets over in Europe as well. So all in all, Europe and the US, very, very strong. We are seeing some falling PMI data across Europe, mostly due to supply chain bottlenecks, which I think are going to last longer than people think. But other than that, strong markets everywhere. Now, of course, if we come over and we look at the, and this backs it up too. If we look at the index performance for the Euro stocks, the FTSE CAC 40 and DAX, all in the green. And you can see year to date double digits in the green as well. Okay. Leading the way is the CAC 40, the French index, at 26.83%. Now, if we look at the Asian markets, those are the ones having some problems. Japan seems to be the only one in the green for the week. You can see the Nikkei had a strong week at 2.49%, primarily because Fumio Kishida was formally elected the prime minister of Japan. And he's a big stimulus guy, a very dovish guy. So he's already saying he's in the process of drawing up a large-scale stimulus package that's going to be released sometime middle to later part of November. So the markets obviously love money like a 5-year-old kid loves a chocolate bar. So you can see the Nikkei's moving back up 7.9% year to date, 2.49% for this past week. Now look at the Asian markets in China. Really ugly. Headline news in China, they're still having problems in the real estate property sector. They're seeing some growing COVID cases. And China's shutting the markets down. Plus, Xi is really going after technology in the education sector, still doing a lot of that. In the property sector, we're seeing a deepening liquidity crisis. They're doing a lot more debt defaults, credit rating downgrades, which then in turn makes it harder for the real estate developers to go out and refinance their loans, which puts them deeper in the hole. You're seeing a lot of selling in real estate stocks. Bonds of major developers are having trouble. And then on top of all of that, if that wasn't enough, the PMI data coming out of China now slipped below 50. It came in at 49.2 in October. Keep in mind, anything below 50 shows a contraction, okay? So all in all, China and Hong Kong, which is now part of China, really, they're all suffering. Keep in mind, China is the second largest economy on this planet, and it's going to slowly start to affect the U.S. markets and the European markets. European markets, the PMI data came down, as I said, they're having supply chain bottlenecks. That's going to continue to be the case. And I think a lot of this is going to wash up on the U.S. shores. So we've got to be really careful here. Take advantage of the year-end seasonality, the markets to finish higher. But I think going into Q1 of next year, things are going to change a little bit. Now, one other chart, I'm going to just include it in my weekly updates. I update the 2020s decade on the far right, but you can see the number of bear markets by decade. We've had 26 bear markets as defined with the markets fallen more than 20%. Okay. We've only had one in the 2020s. That was COVID, obviously. But you can see the decade. Now, this is performance by decade, not by year. If you were to average all these, the average is roughly about 10, almost 10.4%. Okay. Going back to the 20s. And you can see here that we've only had 2 decades that we were in the red. The 30s, that was off of the Great Depression, and the 29s, 1929, 1930 in the US, and in the 2000s here in the US, which incorporated the dot-com bubble and the great financial reset in 08 and 09. We had 4 bear markets during the 2000s decade. The highest was the 9 bear markets that we had coming off the Great Depression in the 20s going into the 30s. But you can see typically when we have a really strong performance, we had in the 2010s, we had 173% return. In the 80s and 90s, you can see 228%, 317% for that 10-year run. Okay. And then it started to slow in the 2010s. I think it's going to slow a little bit more in the 2020s, leading up to 2030. So net, your takeaway from this graph should be essentially that typically when we have a strong year or two return, the markets settle in a little bit for very low returns before markets come back again. Okay, so what I want to do is I'm going to switch the screen. So I'm going to switch the screen and then mute my mic for a second. I got to grab a glass of water. Hang on one second. Let's get this going here. All right, like this. Okay. Let me just mute my mic real quick. Okay, I've got you back. Let's take a look at what we're seeing right here. You're going to see just a huge rebound off this little dip that we had in September. Okay. Just a huge rebound. Now you can see here, with that move higher off that dip, just a really bottle rocket. I mean, it ended right at the end of September. That was the move lower. And then away we go. Okay. You can see I've calculated a fib pullback based on this. This is an Elliott Wave 3 move higher, 47.1175. We blew through my initial resistance zone. In fact, I thought we would get a 3% pullback once we hit this resistance zone here around 46.07. We didn't. We blew right through it. So this will then tend to be a support point around the 4600. Okay. Now note we closed out the week at 46.85, so you would think 85 points would be a pretty good little pullback. But I think over a little bit of time, we're going to get a little bit of a dip, but we're going to finish higher. If you guys remember, I'm not sure if I told you guys on the free roundup on the weekends, but I told our members that my target for the end of the year is between 4,600 and 4,750. Now I call that out when we were down around these ranges down here around the 4350 area, 4200. That was my target. Okay. So, in fact, I had increased my target as we were bouncing off this set. Once I saw that we came back above the 50 EMA here, I increased my target. The target was in the 45 to 46. I increased it to 46 to 4750. Okay. And even with the pullback intraday, we still finished in the green, 12.5 points in the E-minis. So pullback point around the 4,500 level. All right, so it's about 185 points. It's not a lot if you think about it. If I just kind of measure this, let's just come in here and kind of pick the middle of the pullback point, about, call it 3.8% down to the lower end of about 5%. So another 5% pullback. I don't think we're going to get that before the end of the year. I think we're going to get a 2 to a 3% pullback, if that, but we're going to be off to the races, guys. Off to the races. Now, another chart I'll show you that I don't normally show our members, but I'll show you this one too. I'm using another charting package on this, but let me just switch the screen up and I'll show you what I'm looking at for a target here. Let me just get this on the screen here. And you can see typically on this chart, anytime we get a green bar print, you want to be bullish as long as the MACD is crossed to the upside. So the target here was right around here, around early October. And then we would have gotten out right here because we had red bars, but we were above the MACD. But we got a confirming green bar again around the middle of October, and it was just a bullish ride all the way up. Now, you'll notice all these lines on here. The thinner lines are a fib pullback node, and then the thicker lines are an extension mode. Typically, when we extend, we go up to the 1.61. You'll see it sitting at 47.72. So, and I had said 47.50, so it's even moved up a little bit beyond that to the 47.72. The 50% extension's 47.39. The 38 is right around 47.05, which we blew through to 47.11. Right, and that intraday, you can see we hit it and pull back hard. So I'm calling for the 46 to 47.50 at the end of the year. Now, remember, we can go up higher than that. I just think by the end of the year, we're going to finish in that range. Okay, so that's a little bit about one of the charts that I review and just kind of go through with our members that gives us some really good signals on how to play this thing. Now, if we come back to my other chart here, and we take a look at not only the E-minis, but if we look at the Dow also blew through my support area. And as you can see, we were over 36,000, okay? Pullback point below the 36,000 again. And I see us having a little bit of a dip, but not much. Okay. And then, of course, if we look at Nasdaq has been strong as well. If we look at Nasdaq, you can see we've blown up over 16,000. Same issue as before. We blew through my near term before we had a 2 or 3% dip. I think we're setting up for a dip back to this little level here, right around just slightly below the 16,000 level. Okay. Remember, our correlation between the VIX and the S&P was positive ending out the week. So that always tends to mean the VIX is going to win out in this battle, okay, short term. Again, I'm still bullish through the end of the year, but I'm looking for a dip. So that'd be a good time for some of you to load up on the markets if we do get that dip, which I think the probability favors it. Now, if we come in here and we look at the Russell's been on fire, okay? On the Russell, you can see this huge breakout that we had, right? There's the breakout. We've traded in this range, going all the way back to March 15th, and we had a all-time high over here around March 15th, but we've been in this range, right? We finally broke out, and you can see when we broke out of the prior all-time high right there, we broke out on that this week, okay, on November the 3rd. And away we went. Now, I can see a retest of the 2366, but the breakout has been done. Also understand, even though we've got strong seasonality through the end of the year, November and December across all U.S. indexes, the Russell is the one that has the strongest, bar none. It is very strong seasonality. Now, for our members, I was telling them to lock and load. If we break out of this, this was the trade I said you got to play. TNA, Tango November Apple. This one also moved up and it also broke out, but it moves out. It's a small cap 3X bull. So it moves like rocket ship, and away we went. So that one was just good for some of our members that made that play. Okay. Now, if we look at the SPX, look at this ratio chart of the SPX or the S&P over the equal weight S&P. You can see it moving up like that. What that means, and we broke out of this range here and just took off. That means a fewer number of stocks are driving us higher, and some of those. Even with the FANG, they're not as strong as some of the other ones. But if we look at the FANG, you can see we also made all-time highs there as well, right? Here's a specialized index of the FANG, which is composed of Microsoft, Facebook, Apple, Netflix, Google, and Amazon. New all-time highs on Friday. Very strong, okay? Very strong markets. You can see here we're almost up where there's almost no divergence in the trade, right? Almost no divergence. So that just tells me that we're strong all around. Now, if we look at the Dow Jones Transports, not new all-time highs, but very close. You can see we're almost in this kind of cup and handle pattern where we will come up here, pull back about that 3%, which is kind of what I'm looking for, and then we're off to the races. The target here is around 305, right? Now, this is an ETF that tracks Dow Jones Transports. Keep in mind, as the supply chain becomes unclogged, you'll see more strength in the transports. And that's another reason why we're just jamming harder off of that. You could see the bounce off the 200 EMA. Now, let's look across the planet and see how everybody else is doing. If we look at the world index, Vanguard World, we're the last all-time high we made was in the summer, and we're making lower highs. So the rest of the planet is not doing very good. Now let's look at the emerging markets. The emerging markets is even worse. We're going down like that. In fact, I could connect this in a regression channel, and all it does, it's a wide channel, but it shows we're making lower highs and lower lows. Not very good. Now look at China. This is a tracking stock for the Shanghai. We're not even we're below where we started in the red, right? Now, my other chart included different stocks, but essentially the takeaway from these is the big countries that are, China and emerging markets, right? And the Vanguard All World Index, everybody else is bringing up the rear. We're well in advance. What that tells me is you're going to probably see some overperformance across Europe and the rest of the planet and underperformance in the US, but not before the end of the year. I think we still have a little bit more of a blowout to go, and then you're going to see that reverse back. Members, we'll go through that in more detail tomorrow evening for our weekly market watch. And by the way, speaking of tomorrow evening, tonight, remember, for those you US bound folks in most states in the United States, you got to turn your watch back 1 hour tonight. We're getting off of daylight savings time, which I always hate. I like it lighter in the evening. But notice here, and let me just move this out some, just get this like this. Notice here that we moved up while the S&P is moving up, right? If we just kind of take a look at it, you can see we're moving up, right? And the S&P finished strong. So whenever you get that positive correlation, keep in mind the markets just they want to come down, right? They want to do it. That's just kind of the nature of the beast. So that's kind of where we're sitting right now. And then we've got a long way to go, obviously, to get up into black swan territory. We're not going to hit that. I think what we're going to do is we're going to stay in this yellow zone. Keep in mind, we haven't been in the green zone since COVID of last year. If I go all the way back, right, and take us out, last time we were in the green was right before COVID, middle of February 2020. And then, as I said, and I told our members, we've got a special way to trade volatility. We got about an 85 or 90% hit rate on how we trade volatility. We don't have a trade in it now, but there will be a time when we do have a trade in it, right? So this is our way that we trade vol. I'll review it again with our members over the weekend tomorrow evening. But this is where we're sitting. We just cannot get into the green. I think we're going to have higher volatility for sure. until we settle down. And I think it's going to be even choppier for 2022, right? So that's volatility. If we look at the bond market, interesting, all right? Bonds moved up strong. Look at this, huge move up. Now, why would the 30-year bond move up? What the bond market is saying, remember, the further you go out in time, the less control the U.S. Feds have over it. Now, they're tightening. Understand, when you tighten, that is a form of quantitative tightening, is a form of raising interest rates. So why would the bond market be going up and interest rates going down? The bond market is essentially saying we're more fearful right now of a slowing economy than we are of higher inflation. The back end of the curve is suggesting that inflation is going to start to come back down a little bit. Okay. I'm not an entirely believer of that. We will see. We will see how that plays itself out. Right. But understand that's what we're looking at. And if we look at the 10-year interest rate, okay, the 10-year interest rate has come off of the highs. Okay. And we're blew through the 50 EMA. I think it's going to settle in down here and it's going to move higher. But the 10-year interest rates and the 30-year bonds are suggesting that the markets are going to slow down. The economic growth is going to dramatically slow down. We know the markets are going to slow down. We know growth is going to slow down. This is saying it's going to slow down a lot more than people think. All right. Remember, the bond markets are traditionally the smart money. So we're going to see how that plays out. And of course, if we look at the dollar index, which is an index of a basket of currencies, we actually made a new high here on Friday before it peeled back a little bit. Okay. Now, I still believe that the dollar over time is going to come down. All right. But we're getting this year-end rush. So just be careful where we go coming out of Q4 of this year. Okay. I think we're going to have a probably more of a 5 to 10% pullback in Q1 of next year. Right now, we want to remain bullish. Okay. I mean, that's kind of where we want to set up. And of course, if we come down here and we look at metals, gold, I think gold over the next 2 years is going to be much stronger. Right now, it's just been a chop trade. Over the next couple of years, it's going to be stronger. So gold and silver is a good place to be. It's a cheap ETF right now if you don't want to trade silver futures. It's a cheap ETF. So playing it to the upside makes sense to me. Copper, well, you know my thought on copper. We want to be bullish copper. Notice all this chop. There's a reason why it's chopped. Keep in mind that for every EV automobile built, it uses 40% more copper than a gasoline powered automobile. So that's tremendous bullish pressure on copper. We've made a big move in that coming off the pandemic lows. You can see right here, I got our members long copper. Okay, copper futures and copper ETF. And it's just been a rocket ship ride. We've done very well in that. Now notice this change. Part of the change is digesting this move up. That's a huge move, guys. The other part of the change is China is a big buyer of copper. And as I showed you in the other ETF, China's below water year to date. Their whole economy is suffering right now. And it's going to eventually wash ashore in Europe and the US, but not right now, not before the end of the year. But China's suffering, and they're building materials that use a lot of copper in their building materials. So they've cut back on that. So that also has had kind of a cross counter effect to the strong demand requirements for EV automobiles. So that's what's caused this. Once we break out of this, and I think the higher probability breakouts to the upside, we're going to run some more. So in this area here, we're trading copper a little bit different until we get that breakout again. So that's a little bit about what I see in some of the metals market. And then, of course, if we look at energy, if we look at oil, well, we had a strong day on Friday. Let me just peel this back. You can see this big move here. I think energy, I had a pullback estimate of down around the high 70s. We pull back to 78.33. I think we're going to be in a chop mode. I don't think it's going to go much higher than this. We may through the end of the year, but China is a big buyer of oil. Their economy's suffering. Their PMIs are in contraction territory. PMIs pull back across Europe. All of that tends to be negative oil. Okay. Um, so we'll see how this thing plays itself out. But the bullish side of oil is with the supply chain constraints that tends to be more bullish oil right now, driving the price of oil higher. We'll see how it plays. Nat gas, well, nat gas is, as usual, very volatile. And as I told you guys right up here, you want to fade nat gas. I'd like to see nat gas. I think if we have a cold winter here and in Europe, nat gas is going to be over 7, and then we're going to want to fade that move again. Okay, so that's a little bit of a quick rundown of some of the key markets that we're following. Members, I will see you tomorrow evening for our weekly market watch. If you're not a member, I highly encourage you to come in. Just some of our trades in the commodities will pay for years of our service for sure. But otherwise, members, I'll see you tomorrow evening, and don't forget to turn your clocks back 1 hour for most of you. Have a great remainder of the weekend, everybody. Members, I'll see you tomorrow evening at 8 p.m. Eastern Standard Time. Ciao, folks.